places or
Welcome,
oh my
welcome scholars and alumni.
I know, but it's better. Like, it's good food at least. Oh, mi casita. Who?
Icons, former astronaut Mae Jemison, and star real-life space traveler William Shatner.
Va a ser el cuarto de Cristian.
Hey everyone, thank you for joining us. We're just giving it a couple seconds for more folks to join and get themselves situated and ready. If you can mute yourself when you enter so that we don't get any of the background interference. Thank you.
Friends,
And Nicole, are you there?
Hello, everyone. I just noticed that I was put on mute, but thank you all for joining us today. My name is Nicole Wesley, Senior Program Manager of Career Supports at TheDream.Us. We are very excited for you to spend your time with us today talking about tax matters for immigrants. This session is being recorded and it will be posted to our YouTube channel post-session. If you do have any questions throughout the session, please feel free to put your questions in the chat. Next slide, please. Before we start talking about taxes, I do want to briefly highlight our ITIN website. In order to file and pay taxes, undocumented individuals need a tax identification number, such as a social security number or an ITIN. An ITIN is an individual taxpayer identification number that is issued by the IRS for individuals who are not eligible for a social security number to file and pay taxes. Beyond using an ITIN to file and pay taxes, an ITIN can also be used to open a bank account, apply for an EIN, and pursue entrepreneurial career opportunities, such as independent contracting, freelancing, and starting a business. Please note, an ITIN does not provide legal status nor work authorization. For more information on ITINs, please check out our ITIN webpage. Next slide, please. When you visit our ITIN webpage, you may also notice a brand new resource that we're very excited to share out. That resource is right above the 3 ITIN handouts titled Tax Matters, Frequently Asked Questions. We hope this timely new resource helps you as you navigate your personal tax matters. Next slide. And as a final reminder, we have one final ITIN session happening in mid-March on Thursday, March 14th. If you have questions specifically related to ITINs, we highly encourage you to attend the March ITINs Open Doors webinar. All these sessions listed on the screen, past and present, will be recorded or have been recorded and will be posted to our YouTube channel. Next slide. Lastly, I want to inform you of a similar but different webinar happening next week titled Immigrant Tax Issues. This webinar is free and co-hosted by NILC, the National Immigration Law Center, and UNLV's Boyd School of Law. Our guest speaker, Professor Francine Lipman, will also be a co-presenter during this webinar. So feel free to also register and attend that session if you are interested. Next slide. And now I will go ahead and introduce our guest speaker. Professor Francine Lipman is a professor of law at UNLV's Boyd School of Law. Her areas of expertise include tax law and taxation of business entities. She is a frequent speaker on tax subjects to law, or on tax subjects. Professor Lipman is a frequent speaker on tax subjects to law and business groups and works with undocumented immigrants in their tax-related endeavors. Professor Lipman is also an IRS authorized certifying accepting agent, or CAA for short, which means she has the ability to assist individuals in completing and submitting their ITIN application materials to the IRS. Professor Lipman, thanks again for joining us today. I will pass it over to you.
Thank you very much, and welcome, scholars. I'm very excited to see more than 100 of you. That's a lot of students interested in taxes, but the cool thing is, 'tis the season, right? It's tax season. So what's interesting about taxes, the good news, bad news, it's very complicated. And so I am going to do my best to give you the high points on tax issues focused on immigrant students, because that's who you are and that's what's relevant to you. Nevertheless, there are amazing resources that you can access online, especially at the IRS's website. The IRS's website is irs.gov, and they have wonderful resources that you can Google, and they are user-friendly. Lots of flow charts and Q&As to see if you qualify for one item or another. But let's get started. Next slide, please. So I'm going to start at the beginning, and the beginning might be, when is your tax return due? So your 2023 federal income tax return. So even though it's 2024, we're talking about the tax return for the calendar year 2023. That tax return is always due on April 15th of the following year. So your tax return for 2023 is due on April 15th. If April 15th falls on a Saturday or Sunday or federal holiday, then it goes to the next business day. But this year, April 15th is not a Saturday, Sunday, or federal holiday. So your federal income tax return for 2023 is due April 15th, 2024. Can you get an extension? The short answer is yes. You can actually get a 6-month automatic extension, but you must file a form. The form that you file is a 4868. Where can you access that? You can access it. It's a very short form. I've actually got a copy of it on the next slide, but it is readily available on the IRS's website. But this extension only extends the time to file your tax return. It does not extend the time to pay any amount due if you owe. If you don't owe any monies to the federal government, but are expecting a refund, then you don't have to pay anything with your extension. But if you do owe money, you should pay with this extension. If you don't pay by April 15th what you owe, then the federal government has some sticks. And those sticks to force you to pay timely are interest and penalties, but they're only assessed on any amount of taxes that you actually owe. If you're owed a refund, there still is a deadline. If you don't file for 3 years, so you have the statute of limitations, that's what it's called. You have 3 years from the due date of the tax return to file that return to get your refund. If you file after that date, you will not get your refund. And the federal government is not going to pay you interest on that money. It is very important for you to file timely. So next slide, and let's look at what this extension looks like. So there it is. I promised you it was a short little form. This is an automatic 6-month extension. As you can see, it's pretty straightforward. Your name, your address, your city, town, state, zip code, and then you have to put your social security number. If you don't have a social security number because you don't qualify for one, then you put your ITIN, your individual taxpayer identification number. Unfortunately, if you don't have an ITIN, there's nothing to put in that box, and it's not clear that this extension would be a valid extension. On the other side of this form, you estimate your total tax liability for 2023. And so if this is an estimate, it's not the exact dollar amount. There you might put the same dollar amount as your amounts you've paid in. And so if you've paid in some federal taxes, then I would put that dollar amount that equals your total payment, so there'd be no balance due. Since you are a scholar in this country, you wouldn't check the box that says you're outside of the country, and you're not going to be filing a 1040 NR. So boxes 8 and 9 are not relevant to student scholars in the US. Next slide. So how does the tax system work? And I've come up with this tax formula so you can have some sense, because I've worked with a lot of taxpayers across the country, and people are pretty confused about how the tax system works. So this is a simple rendition of the tax formula. You start off at the top with all of your income items. This is broadly defined to include any independent contract work, if you have any interest income, if you have scholarships that are above and beyond the tuition and fees and required books, if you have any dividends, if you won the lottery, or if you went to Las Vegas and you have gambling winnings, all of that goes at the top. You reduce that amount by deductions. The deductions that are above the line include contributions to, well, something that certainly could be relevant to you would be 1/2 of your self-employment taxes are a deduction above the line to the extent you're an independent contractor. So that reduces your gross income, and we derive a number called adjusted gross income. From that dollar amount, you take the greater of a standard deduction or itemized deductions. 90% of all taxpayers use the standard deduction. For students, I would say it's probably close to 98% of all students use the standard deduction. So that is the amount that is likely relevant to you. Then you reduce your adjusted gross income by very likely the standard deduction, and that equals your taxable income. On that dollar amount, you compute your tax liability. You reduce your tax liability by any tax credits you might get. This would include any taxes you've paid in. It also includes some credits we're going to talk about that are educational tax credits. And then you either owe more, you have a tax due, or you get a refund. So this is a simple rendition of how the tax formula works. Next slide. Filing status matters. What's interesting is the tax rate schedule and the standard deduction amounts depend upon something called your filing status. Your filing status pretty much depends upon your legal marital status as of December 31st. So the way our tax system works, if you step back from it, it's a little bit crazy, but we look at what your marital status is on December 31st. So if you come to Las Vegas and you get married on New Year's Eve, guess what? You file as married for the entire year. So you better think about the timing of your marriage. If you are legally divorced on December 31st, then you file as unmarried. So we don't prorate. If you are married on December 31st, even if you get married at 5 minutes to midnight, you're treated as married for the entire year. If you get unmarried on December 31st, you're treated as unmarried for the entire year. So if you're married, and that includes opposite sex or same-sex marriage, then you must use either married filing jointly, which means you and your spouse file one tax return. And if you do that, you are jointly and severally liable for any taxes. And what that means, as you know, I'm a lawyer, so that's kind of a legal ease. But what that means is you are liable for your spouse's taxes. And so you might want to think about whether that makes sense. Actually, you should think about that probably before you get married. But in any case, if you file jointly, you're joint and several liability. You're both liable for each other's taxes. Another option that you could consider is married filing separately. But there are some significant limits to filing married filing separately. Now, if you're not married, then you have two options. You file as single, which my guess is just because of your age, you are probably more likely to be single. That's the filing status you use. However, if you are single, meaning you're unmarried as of December 31st, and you are supporting a qualifying child in your household, and you provide over half of the support of that household, then you can file as head of household. That is a more advantageous filing status than single. Now, some of you, because you are under age 24 and likely unmarried, to the extent your parents are supporting you, they might be claiming you as a dependent on their tax return. That doesn't mean that you don't have to file your own tax return if you have income, but it's important to know if your parents are claiming you as a dependent on their tax return for other issues that we're going to get to in a minute. So marriage matters. Next slide. So as I said, your filing status determines the standard deduction amount. Every year, the standard deduction amount changes because it's indexed for inflation. So for 2023, I'm giving you the numbers for 2023 because those are the tax returns we're focused on now. But I'll tell you the 2024 numbers have already been released, and they're higher than all of these numbers. So if you're single, then the standard deduction amount is almost $14,000. It's $13,850. If you're married, it's double that. So it's not a coincidence that it's 2 times that. That's how the tax system works for fairness, 2 people in a marriage. Head of household, as you can see, is higher than single, but lower than married. It's kind of in the middle. Now, you might be saying, what's itemized deductions? Well, itemized deductions, again, not likely relevant to folks in this audience, but the itemized deductions typically are going to be for people who own homes and they have interest on their home mortgage. They have to pay state and local property taxes. Maybe they give money to charity. And if they have some extraordinary medical expenses. So you compare your itemized deductions to the standard deduction amount and you take the larger one. And by the way, I know there's lots of questions. I'm going to do some numerical examples so you can see how this works. Next slide, please. So I bet right now your head is spinning and you're saying, oh my goodness, this is too complicated. I have a headache already. Well, the good news is there are helpers out there, and they're across the country from sea to shining sea. There are a bunch of different types. A new one, a brand new one, the IRS is rolling out next month, should be released in mid-March. So that's around March 15th. It's an online free direct file program. Unfortunately, it's only eligible for people in 12 states. Those states are Nevada, Arizona, California, Texas, New York, New Hampshire, Massachusetts, South Dakota, Washington, and Wyoming. So 12 different states that are participating in this pilot program. So if you're in one of those states, you could, or maybe your parents or somebody else could use direct file. Another alternative is free file, which is already available online at irs.gov. And this is another resource where you can do your tax returns for free. It's electronically filing. You can pay any amount of tax due that you owe electronically, or you could have your refund directly deposited in a bank account. So that resource is there now, and you should check it out. Maybe it will be helpful to you. If all of this is a little bit overwhelming, what you might consider is actually going to a volunteer income tax assistance site. These are programs that are across the country with real people, not a computer. They're using a computer, but it's a real person. You sit down, usually make an appointment face to face. You have a conversation and they prepare your tax return right then and there. This link to this website gives you the geographic location of all these VITA sites. Because you are likely going to be filing with an ITIN, you might want to just call and make sure they do ITIN tax returns. The answer should be yes. In addition, if you don't have an ITIN yet, they might actually offer a service where they will help you apply for an ITIN, and they have, hopefully on site, certifying acceptance agents who will be able to authenticate your documents so that you don't have to send in your passport. So I would definitely encourage you to consider going to a VITA site. Another advantage of a VITA site is they typically will do your state income tax return. Again, all of this is free. And last but not least, if you are really struggling to find a resource, I would encourage you, and you've navigated all these potential options and you're coming up flat and you're just pretty confused, you might check out this one link at the bottom of this slide, and that's low-income taxpayer clinics. Pretty much every state has one of these, and while they're not going to be able to prepare your tax return, they might be able to give you some recommendations as to where you can go to get some tax assistance. So there's lots of helpers out there. Don't be discouraged. Next slide. So you might be saying, well, I don't know if I have income. I'm very fortunate to be a TheDream.Us scholar. So is that income? Well, the good news is the answer is generally no. So if you have loans, maybe you borrowed money from a bank, or you borrowed money from a credit card company to go to school, then that is not income, because the good news, bad news about a loan is you have to pay it back. Not only do you have to pay it back, but you have to pay it back with interest. What about scholarships? Well, to the extent scholarships are used for qualified education, tuition and fees, required books, and equipment, that amount is not income. If your scholarships, if you're so fortunate that your scholarships exceed that amount, maybe to pay for room and board, housing, then the amount above your tuition, fees, and required books and equipment, that does have to be picked up in income. So that would have to be reported on your tax return. In addition, if you get a scholarship, but you are required under the scholarship to work. So for example, at my law school, we have research assistants. It's really not a scholarship. These individuals get paid for providing services. That is not excluded. So if you have a scholarship and it requires you to perform services, then it cannot be excluded. I hope that is helpful. Next slide. So what sort of deductions are available to taxpayers like you? Well, if you borrowed money for higher education and when you pay it back after you graduate, that's usually how they work, you're likely going to have to pay it back with interest. So interest on these qualified education loans, that interest is deductible. It is only deductible up to $2,500 every year. And for very high income taxpayers, it's phased out so they don't get this deduction. In addition, if you're claimed as a dependent on your parents' tax return, they would take the deduction, not you. So if you're claimed as a dependent on your parents' tax return, they get the deduction, you don't get this deduction. But this only applies if you have higher education loans and when you start paying those loans back and pay interest. Next slide. Now we're getting to the educational tax credits. There are actually two of them. The first one is the American Opportunity Tax Credit. This is for the first 4 years of college. So an individual who's in their first 4 years of college qualifies for this. The credit, which is a dollar for dollar reduction of any taxes you owe, can be up to $2,500. And the way it works, it's 100% of the first $2,000 you pay for eligible tuition fees and required books. And then it's 25% of the next 2,000. So if you're paying out of pocket, not with scholarships, at least $4,000 of eligible tuition fees and required books, then you potentially qualify for this $2,500 tax credit, which offsets your tax liability dollar for dollar. Even if you don't have a tax liability, you can actually get a refund of 40% of the allowable credit or up to $1,000. And I actually have an example of this we're going to look at together. You have to have a taxpayer identification number to qualify for this. So that's either a Social Security number or an ITIN. It's only for the first 4 years, and it's only for 4 years. You have to be a half-time student at least, and you can't have any felony drug convictions. Next slide. The next educational tax credit is for any higher education beyond those first 4 years. So beyond the first 4 years, as you know, some undergrads take more than 4 years to finish college. And of course, you can certainly go to graduate school like law school. Love to see you in my class at UNLV. I spend a whole semester talking about tax. So how does the lifetime opportunity tax credit work? Well, it's up to $10,000 of higher education tuition times 20%. So the tax credit is up to $2,000. It's for higher ed beyond those first 4 years, and it's only on up to $10,000 of tuition and fees. Required books aren't counted here. This also phases out for higher income individuals. Next slide. So let's consider a taxpayer. So this is a hypothetical fact pattern. So this is Axel. He is an ITIN holder. He's an undergraduate in his 4th year of higher ed, and he's got $20,000 in out-of-pocket costs for tuition and fees. $10,000 is paid with a scholarship, and he doesn't have to include that scholarship in his income. And the balance is paid with a loan. So if you use a loan to pay for your higher ed, then you can get this American Opportunity Tax Credit. Axel is not claimed as a dependent by anyone, and their 2023 income is $15,000. So Axel is self-employed. Let's say Axel makes, I don't know, what could he make? Cookies, and he sells cookies. So he's not a Girl Scout, but he competes with the Girl Scouts and he sells cookies. So he's doing pretty well. His income from his cookie sales, $15,000. But he can use his standard deduction amount because he's single to almost wipe out all of his income. So his taxable income is only $1,150. His tax is only $115 because the lowest tax bracket is 10%. Well, he paid $10,000 in higher education, so he gets the American Opportunity Tax Credit. However, he's only going to use, so he gets the full $2,500, but only $115 is going to be used to offset and completely wipe out his income tax. But because he's self-employed, he has to pay payroll taxes on the $15,000. And payroll taxes are 15.3% of your net earned income. So that's $2,119. But the good news is he can offset that amount owed with $1,000 of American Opportunity Tax Credit for that $10,000 that he's paying for college. That's the maximum refundable credit that he can use to offset your self-employment taxes. So when Axel files his federal income tax return, he has to pay $1,119, and that's all his self-employment taxes on his $15,000 of entrepreneurial activity as a cookie maker and seller. Next slide. Now we have Axel is still doing well with his cookies, but he's in his 5th year of higher ed. And so he no longer qualifies for the American Opportunity Tax Credit. And so he doesn't, the American, the lifetime learning tax credit is not as favorable as the first 4-year credit, American Opportunity Tax Credit. So same amount of gross income, same amount of standard deduction. his taxable income is the same, his income tax is the same, and it's completely wiped out with his lifetime learning tax credit. Even though he gets $2,000, he can only use $115 because, unlike the American Opportunity Tax Credit, the lifetime learning tax credit is not refundable. So none of it can be offset against his self-employment taxes. His self-employment taxes are the same because it's on the $15,000. So he owes $2,119 by April 15th when he files his tax return. Next slide.
Francine, I'm going to chime in
Please
due to
do.
time, and I know we have a lot of great questions. So
Good.
Nicole and Kia, if we could go to the next slide, which is our last slide.
Yes.
And now we're going to transition into the Q&A. So I've been watching the chat, and the first question I'm going to ask Professor Lipman is, I recently received an email stating that I had to state my scholarship, and I want to know, how do I do that? And do I need to report my scholarship for taxes?
So who sent you the email? Who is the email from?
It doesn't say, but I assume it may have come from their college.
Okay, so is that Juliet with her hand up, maybe?
Yes, that's me. Sorry about that. The email was sent by my advisor from the scholarship. So that's how I knew.
So the scholarship, you only have to include on your tax return any scholarship that you receive that exceeds your tuition fees and required books, or any scholarship that requires you to perform services, so to work. Does that make sense? So you do not have to include that scholarship on your tax return.
Thanks, Francine, for answering that question. And Juliet says, yes, it makes sense to her. Next question. What does standard deduction and itemized deduction mean?
So the standard deduction amount is an amount that everyone receives to offset your income, so that the way I think of it is it's a zero bracket amount. So our federal government looks at a single person and they say, if a single person is only making $13,850, that is basically poverty level. And so you will get to offset a full standard deduction amount against that so that your taxable income is zero. Now, the federal government also wants to incentivize certain behavior, like buying a home. And so if you buy a home, and most people buy a home by borrowing money from a bank, they don't pay cash, the interest you pay on your loan to buy the house, that interest is deductible. But you're only going to itemize your deductions in lieu of the standard deduction if that dollar amount exceeds these standard deduction amounts. And as I said, in the last 5 years or so, actually longer than that, probably 6 years, the standard deduction amounts have been so large that 90% of all taxpayers, meaning the rich and the not as rich, use the standard deduction amount. And students like you are most likely, very likely to use the standard deduction amount. So that basically means for 2023, you could have income of $13,850 and you can offset it in full with this standard deduction amount, so your taxable income would be zero.
Thank you for clarifying that question. Next question. If I'm living under my aunt's house and am under 24 years old, can they claim, can I be claimed as a dependent?
So that's a great question. And it matters, of course. That's what lawyers always say. It matters. And I'm assuming that this person is really your aunt and not just someone you call aunt, because a lot of people call me auntie, but I'm not really their aunt. So it's got to be your mother or your father's sister, right? So that's the way it would be your legal aunt. If she is your aunt and you're living in her household and you are a full-time student under 24 and she is effectively paying for all the costs of that household, then the answer is yes, she can claim you as a dependent.
All right, next question. A professional tax preparer filed my 2023 taxes. I have a W-2. This year's tax return was very low, around $30. I live in the state of Virginia. I don't have any debt, children. I'm not married. Do you know why my tax return was so low?
So I'm going to push back a little bit on different descriptive words. So a lot of people will call their refund a tax return, but that's not a tax return. The tax return is what you file. So I'm just clarifying you. A lot of people misuse that language. So you're saying your refund was low. It probably was low because they didn't withhold much in taxes. And so my guess is if your wages were less than $13,850, which if you're a full-time student, they probably were, then your taxable income would be zero and you would get all of your federal withholding back. But if they only withheld $30, you probably got it all back.
Next question. What if I have no income? Do I still file taxes?
If you have no income, the answer is you do not have to file a tax return. There is an exception to that general rule, and that is the last slide in this PowerPoint, which was showing someone with no income. They were not claimed as a dependent by anyone, but they did have out-of-pocket costs for tuition and fees and required books. So their scholarships didn't cover all those costs. So they had to pay some tuition and fees. Then they would qualify for the American Opportunity Tax Credit, and they could potentially get up to $1,000 refund. But I want to caution you, because if you file a return with zero income and you're claiming this credit up to $1,000, the IRS is naturally going to be wondering, how did you survive during the year if you had no income? So you want to make sure you report all of your income, and perhaps you are really a dependent on your parents' tax return because you lived at your parents' home and they effectively supported you. But if you live, I have worked with some students who basically lived off of their savings, and they then, and maybe some student loans, and they could file a tax return with zero income and claim this credit.
Next question. Can a citizen spouse file joint taxes with an immigrant spouse that doesn't have an ITIN or a social security number and is unemployed?
Great question. The answer is yes, yes, yes. Happens across the country. And it's very, very important. If you are married, you want to make sure your tax return indicates that, because we're all hoping someday for a pathway to citizenship. And you want to make sure that your tax return is consistent with your fact pattern. Meaning, if you're married, your tax return should show that. If you're not married, your tax return should show that.
Next question. What does it mean for those who are claimed as a dependent, and why does it matter if we get claimed as a dependent?
So if you are claimed as a dependent, then certain tax benefits are not allowed to you. They effectively pass through to the person who is supporting you. However, that doesn't mean that if you're claimed as a dependent, that you still very might have to file a tax return. So for example, your parents claim you as a dependent, but you worked during the year, you file a tax return and you check the box that says I'm claimed as a dependent on somebody else's tax return, and then you don't get certain benefits. You do get the standard deduction amount, but it's only up to your earned income. So it's the treatment's a little bit different, but the concept is someone is supporting you, which means paying your bills, etc., and therefore they should get the benefits, not so much you.
I also see a follow-up question that relates to this. Is there an age where you cannot be claimed as a dependent anymore?
Yes. So if you're under 19, you can be claimed as a dependent, or under 24 and a full-time student. So once you hit 24, even if you're a full-time student, you are basically not to be claimed as a dependent.
These are all great questions. I'm going to fire another one at you. My scholarships are more than my tuition, but I am using that extra money for on-campus housing. Would I be filing that in my taxes, and will I be owing anything?
That's a great question. And so the answer is, to the extent your scholarships exceed your qualified tuition, required books, and required equipment, to the extent you do a lab and you have to have a microscope or something, any amount in excess of that has to be included in income. And so it sounds like you have amounts in excess of that, and even if you're using it for housing on campus, you still have to report that on a tax return. And if it exceeds, if you're single, $13,850 for 2023 if your amount above required tuition, books, and equipment exceeds $13,850, then you're going to owe 10% of that amount above that, but likely not, my guess is. And boy, if you get scholarships of that large of an amount, a little bit of tax is really worth it.
Next question. Are both the TheDream.Us scholarship and TAP award already included in the 1098-T form that the college reports for 2023?
So the 1098-T is showing what you paid to the university. And so it should include the amount of scholarships that you received. I don't know how the scholarship works, whether it goes to you and then you use it to pay your tuition, or whether it goes directly to the university. And so
it goes directly to the university.
So it should be on the 1098-T. You could imagine a scholarship that doesn't go directly to the university, that goes to you, and then the university wouldn't know about it. And so they wouldn't be reporting it.
Next question. My girlfriend is changing her visa into a student visa, and I will be covering her expenses. Can I put her as a dependent?
The short answer is no. I guess under some pretty unusual circumstances, meaning that if she's not related, right? She's a girlfriend. And so if she lives in your household and you provide over half of the cost of that household, and she doesn't make more than $4,000 a year, then, and she has to live with you for the entire year and you provide all the support, then perhaps. But it's a facts and circumstances analysis. And so that is a good thing to take to the irs.gov website, and they have a Q&A to see if you can claim somebody as a dependent. If she doesn't make more than $4,000, then potentially if you live together the entire year and she, I guess, lived together, unrelated, lived together, she doesn't make more than $4,000, and you supported the entire household.
Thanks, Francine. We are closing in on time. I'll ask one, maybe two more questions. But I do want to let everyone know that if you want to learn more about tax matters for immigrants, I put in the chat an upcoming free webinar on immigrant tax issues that is being co-hosted by NILC and UNLV's Boyd School of Law. So you are welcome to register for that. We are also having, hosted by TheDream.Us, our last iTunes Open Doors session at the end of, in mid-March on March 15th. I will go ahead and ask one more question. If you're self-employed but not making more than $13,000 and you're a dependent college freshman, do you still have to report that income?
You do, because self-employment income requires you to pay payroll taxes. So when you work for an employer, your employer pays your half of your Social Security taxes and half of your Medicare taxes. And then the other half, they take out of your salary. So you don't even know it's coming out, but you are paying it, half of it. But if you're self-employed, you're the employer and the employee, so you have to pay both halves of your payroll taxes. And that's that 15.3%. So you will have to pay that on your net profit. You won't have to pay any income taxes, but you do have to pay self-employment taxes.
Well, thank you everyone for your time today and wonderful questions. I know we didn't get to all of them, but if your question is still left unanswered, feel free to reach out and email Professor Francine Lipman. Her email is on the slide there. As always, Professor Lipman, thank you so much for your time and expertise in answering all of our scholars and alumni questions. We greatly appreciate it. As a reminder, this is being recorded and everyone can refer back to this recording on our YouTube channel. It should be posted by the end of this week or no later than early next week. Thank you everyone for your time and enjoy the upcoming weekend.
Look forward to anyone seeing you on February 29th. And we're hoping it's going to be translated into a number of different languages, of course, including Spanish, and we're hoping even Korean and some other languages. So please sign up ASAP because they have hundreds of people already and it will cap out.
All right. Thank you, Francine, for promoting that session next week. And everyone, take care.
Aloha.